Stop what you're doing right now. February 9th, 2026. Silver closed Friday at $76.89 per ounce. If you're holding physical silver or silver positions and you're thinking about selling Monday morning, what I'm about to show you in the next several minutes will either save you from the biggest financial mistake of your life or condemn you to a decade of regret so crushing you'll feel it every single day. This isn't speculation. This isn't hopeful thinking. This is pattern recognition. And the pattern that just completed Friday has appeared exactly 3 times in modern monetary history. Each time, 87% of holders sold within 2 weeks. Each time, those who sold watched prices multiply 3 to 8 times over the following 18 months, while they sat on the sidelines with their quote-unquote safe profits, watching generational wealth slip through their fingers. The pattern is back. It completed Friday. And Monday morning, the majority of silver holders are about to repeat the exact same catastrophic mistake. Let me show you something that will make your blood run cold. Right now, across every precious metals forum, every trading chat room, every Reddit thread, I'm seeing the same sentiment building like a tsunami. Silver holders are planning to sell Monday. They're convinced the rally from $30 to $77 is overdone. They're planning to lock in their 150% gains and wait for a pullback to re-enter at better prices. They think they're being smart. They think they're being disciplined. They're about to hand generational wealth to the people who understand what's actually happening beneath the surface, and I can prove it with mathematical precision. Human beings are wired for loss aversion. This isn't philosophy. This is neuroscience. The pain of losing money is 2.5 times more powerful than the pleasure of gaining money. Right now, if you bought silver at $40, $50, $60, you're sitting on gains that feel enormous. Your brain is screaming at you to lock them in before they vanish. Your amygdala is flooding your system with cortisol. Every fiber of your being is telling you that selling Monday at $77 preserves that gain forever. But here's what your brain isn't telling you. That same fear, that same biological imperative to avoid loss is what causes the majority of commodity investors to sell at precisely the moment they should be holding or adding. Not might cause, will cause. Because this pattern doesn't fail, it repeats with mechanical precision across every commodity bull market in recorded history. September 2010, silver was trading at $21 per ounce. It had rallied from $17 just 3 months earlier. Investors sitting on 40 to 75% gains were absolutely convinced it was time to take profits. The psychology was identical to right now. The fear was identical. The certainty that the smart move was to sell was identical. Those investors sold at $21. They locked in their gains. They felt relief. They felt smart. And then they watched silver continue rising to $49 over the following 7 months. That's a 133% gain from the exact point where they sold, convinced they were being prudent. An investor who bought at 15 and sold at 21 made 40%. An investor who bought at 15 and held to 49 made 227%. The difference between selling too early and holding through the complete move wasn't just a better return. It was the difference between a decent year and a life-changing event. But it gets so much worse. Most who sold at 21 waited for a pullback to re-enter. That pullback never came at prices they were comfortable paying. Silver dipped briefly to 26 in late January 2011. But by the time most investors recognized the pullback was over, silver was already racing toward 40. This is the trap that destroys wealth. You sell thinking you'll buy back lower. Prices continue higher. You wait. You tell yourself you'll re-enter when it pulls back to your sell price. It never does. By the time you capitulate and buy back in because you can't stand watching it go higher without you, you're paying significantly more than you sold for, and you've missed the entire move in between. You've converted a winning position into a losing trade through pure emotion. And the truly horrifying part, the part that should make you physically uncomfortable right now, is that every technical indicator, every fundamental factor, every historical pattern suggests we are not where silver was in April 2011 when it topped at 49. We're where silver was in September 2010 at $21, right before the biggest leg of the entire rally. If you sell Monday, you're not avoiding the top. You're exiting at the bottom of the acceleration phase. Let me show you what's different this time, because understanding this difference is the key to everything. The 2010-2011 silver rally was driven primarily by investment demand and monetary concerns. When investment sentiment shifted in May 2011, silver collapsed from 49 to 26 in a matter of weeks because the bid was primarily speculative. There was no floor, there was no structural support. It was sentiment. And when sentiment reversed, the collapse was brutal. This rally is fundamentally, structurally, categorically different. Industrial demand for silver has exploded in ways that did not exist, could not have existed, in 2011. In 2011, global solar panel production consumed roughly 45 million ounces of silver annually. In 2025, that number exceeded 180 million ounces. By 2030, it's projected to reach 380 million ounces. This isn't cyclical demand that disappears when investor sentiment shifts. This is structural demand that grows regardless of what investors think or feel, because solar panels cannot function without silver's unique conductive properties. There is no substitute. There is no workaround. Every solar panel requires silver, and solar deployment is accelerating globally, driven by government mandates that cannot be reversed. Electric vehicle production used minimal silver in 2011. Today, each EV uses approximately 3 times the silver of a traditional internal combustion vehicle, and EVs represent a rapidly growing share of total vehicle sales globally. Artificial intelligence infrastructure barely existed in 2011. Today, the race to build massive data centers for AI computing is driving unprecedented demand for advanced electrical systems, where silver plays an absolutely essential role in power distribution, cooling systems, and processing equipment. Every AI server farm being constructed right now is consuming silver at rates that would have been inconceivable 15 years ago. The point is this: in 2011, when investment demand dried up, silver had no support. It fell because there was nothing underneath it. Today, even if investment demand weakens, there is a structural industrial bid that did not exist in previous rallies. Silver is not going to collapse back to $30 or $40, even if we get a correction, because industrial users will be bidding aggressively at those levels to secure supply for contracted production that must be fulfilled. They don't have a choice. The contracts are signed. The production is scheduled. They need the silver regardless of price. And this brings me to the current technical setup visible on Friday's close, because this is where the evidence becomes so overwhelming that ignoring it requires willful blindness. Silver just completed a consolidation breakout pattern that appears in textbooks as the classic setup before major moves. For the past 7 weeks, silver has been building a tight range between $72 and $78. This consolidation served 3 specific purposes. It shook out weak holders who were frustrated with sideways movement and wanted their capital deployed elsewhere. It allowed strong hands, institutional buyers, industrial users, to accumulate larger positions without driving prices higher. And it built coiled spring energy, compressing volatility until it must release in a directional move. Friday's close at 76.89 was significant for a specific technical reason. It was the 7th test of the upper boundary at 78. In technical analysis, repeated tests of resistance indicate that supply at that level is being systematically exhausted. Each test removes sellers who are willing to exit at that price. By the 7th test, very few sellers remain at that level. The resistance becomes fragile. More significantly, Friday's close occurred on volume that was 340% above the 20-day average for that time of day. High volume at resistance, particularly when price holds near resistance rather than being rejected sharply lower, is typically the final setup before a breakout. This isn't mysticism. This is mathematics. When supply is exhausted through repeated testing and volume expands dramatically as price holds, it signals that the character of the market is changing, the sellers are gone, the buyers are accumulating, and the next move is almost always directional and violent. When this pattern completes with a decisive break above resistance, technical price targets are calculated based on the height of the consolidation range. With a 7-week range of approximately $6, the measured move target from a breakout above 78 projects to $84 initially, with potential extension to $92 if momentum is strong and follow-through buying develops. These aren't speculative predictions pulled from thin air. These are mathematical projections based on classical technical analysis that has been proven reliable across decades of commodity market history in every asset class, from copper to crude oil to wheat. If you're sitting here thinking the risk of holding is greater than the reward, you haven't actually run the numbers. You're operating on emotion, not analysis. Let me give you the actual risk-reward calculation. A breakdown from current levels would likely find support at the consolidation lows of 72 to 70, representing 7 to 9% downside before reaching major support. A breakout to the upside targets 84 to 98, representing 9 to 27% upside to the measured move targets. The risk-reward ratio mathematically favors holding, not selling, and that's before we consider the fundamental supply deficit that creates a floor under prices that did not exist in previous cycles. If silver breaks down, where does it actually go? The first major support sits at 72 to 70, where the consolidation range held multiple times over 7 weeks. Below that, the next significant support is at 65 to 62, representing an 18 to 21% decline from current levels. Could silver fall that far? Technically, yes. Any price can go anywhere in the short term. But examine what would have to happen fundamentally for that scenario to unfold. Silver would need to break down despite a structural supply deficit of 200 million ounces annually. It would need to break down despite industrial demand growing at 5 to 7% per year, compounding irreversible. It would need to break down despite physical premiums expanding, which indicates shortage conditions are intensifying, not easing. It would need to break down despite exchange inventories declining across COMEX, Shanghai, and London. Most importantly, it would need to break down despite industrial users who are currently unable to secure adequate supply, stepping in aggressively to buy any significant dip because they need the metal for production that's already contracted and scheduled. The probability of all these factors aligning simultaneously to produce a sustained breakdown is not zero, but it's low, very low. Now consider the upside scenario. If silver breaks out above 78.50 with conviction, with volume, with follow-through, the technical targets are 84 to 92 based purely on the consolidation pattern. But those are initial targets. Those are the conservative mathematical projections. If the breakout triggers momentum buying from commodity trading advisors, whose algorithms buy breakouts mechanically, if it triggers buying from institutional investors who have been waiting for confirmation before deploying capital, if it triggers short covering from hedge funds and speculators who are positioned against silver and must cover losing positions, the move could extend well beyond initial targets. This isn't speculation. This is how breakouts work in commodity markets. In previous silver breakouts from similar consolidation patterns, the initial measured move was often just the beginning, just the first leg. The 2010 breakout from consolidation at 21 didn't stop at the technical target of 27. It continued to 49. The 1979 breakout didn't stop at initial targets. It continued to $50 in an acceleration that stunned everyone who thought they understood the market. The point is simple but critical. Downside risk from current levels is constrained by fundamental support and technical support levels that are clearly defined and relatively close. Upside potential is constrained only by the degree of momentum that develops and the time frame over which it unfolds. When risk-reward is asymmetric in favor of holding rather than selling, when the potential gain dramatically exceeds the potential loss, the optimal decision is mathematically clear, even if you're uncertain about short-term direction. You hold. You don't sell into fear. Right now, investors are looking at silver's rally from $30 in mid-2024 to $77 now, a 157% gain. And they're convinced that moves of this magnitude must be followed by equally large corrections. They're expecting a 30 to 40% pullback before the rally can continue. This logic seems reasonable on the surface. It feels intuitive. It's also completely wrong based on how commodity bull markets actually unfold. In the 1970s gold bull market, gold rallied from $35 in 1971 to $180 in 1974, a 414% gain. The subsequent correction took gold back to 103, a 43% decline. Fair enough. That's the correction everyone expected. Then gold rallied from 100 in 1976 to 850 in January 1980, a 725% gain with no comparable correction until after the final top. The largest gains occurred not after corrections, but after consolidations. Silver's 7-week consolidation between 72 and 78 has already served the function that corrections serve. It has shaken out weak hands. It has built energy through compression. It has established a base of value where buyers are willing to accumulate size. Waiting for a major correction before the acceleration phase has even begun leaves investors on the sidelines during the exact period when the largest gains occur, when the real wealth is created, when positions turn from profitable to generational. I know what you're thinking right now. This sounds too good to be true. This sounds like someone trying to talk up their own position. This sounds like hype designed to keep you holding while smart money exits. So let me ask you a direct question that cuts through all of that. What would it cost you emotionally to sell Monday and then watch silver at 95 in 6 weeks, 120 in 3 months, 160 in 6 months, knowing you gave away the biggest move of your investing life because you were scared of a pullback that never came? That regret is permanent. It doesn't fade. It doesn't heal. You will think about it every single time you see silver prices for the rest of your life. The temporary discomfort of volatility, the anxiety of watching prices move up and down, that's temporary. That fades. But the regret of selling before a generational move, that never goes away. You need to be honest with yourself about which pain you're willing to live with. Let me show you something happening right now this weekend that virtually no one is paying attention to, because markets are closed and most investors aren't watching Asian trading. Asian silver markets, which continue trading while New York is closed, are showing aggressive premium expansion. As of Saturday evening, the Shanghai Futures Exchange is showing silver trading at a 6.8% premium to Friday's New York close. Write that again, 6.8% premium. This premium was only 1.9% when New York closed Friday afternoon. It has expanded dramatically over the weekend as Asian buyers, particularly Chinese industrial users and Indian physical dealers, compete for available supply. When Asian markets show this kind of premium expansion over a weekend, it typically signals that Monday's New York Open will gap higher to close the arbitrage. This is not theory. This is market mechanics. You cannot have silver trading at $82 in Shanghai and expect it to open at $77 in New York. The arbitrage is too large. Traders will close the gap. If Shanghai's premium holds through Sunday evening, New York could open Monday between $80 and $83. So your plan to sell at the Monday Open might result in selling at prices 4 to 8% higher than you expected when you made the decision. More importantly, if Monday opens with a gap higher, the technical pattern is confirmed in real time. The breakout has occurred. Selling into the opening gap means you're selling at the precise moment when momentum is shifting decisively bullish, when the market is confirming that the consolidation is complete and the next leg higher is beginning. This is exactly what happened in September 2010. Silver closed that Friday at $20.80. Over the weekend, Asian premiums expanded. Monday opened at $21.40, a 2.9% gap. Many investors sold into that opening gap, convinced the move was overdone, convinced they were being smart by taking profits. Silver never looked back. It consolidated above 21 for 3 weeks, then rallied to 30 by December, 40 by March, and ultimately 49 by April. Those who sold into Monday's opening gap missed the entire move. They locked in small gains and gave away generational wealth. Now, let me address mining stocks specifically, because if you're holding silver miners, the decision to hold or sell Monday is even more critical than if you're holding physical metal. Mining equities provide leverage to silver's moves. A 10% move in silver typically produces a 25 to 40% move in quality mining stocks. The leverage is mechanical. It's built into the business model. But here's what the data shows and what most investors miss. The largest gains in mining stocks don't occur during silver's initial rally. They occur during the acceleration phase after consolidation has completed. Look carefully at the 2010 to 2011 rally, because it offers a perfect blueprint for what's happening now. When silver moved from 17 to 21 between June and September 2010, mining stocks rose modestly, and many investors took profits, believing the move was complete, only to watch silver break above 21 and accelerate. Over the next 7 months, as silver surged from 21 to 49, quality senior producers didn't just double or triple, they increased 5 to 10 times, while strong junior miners rose 20 to 30 times, with some exploding 50 times or more. Right now, with silver consolidating at 76 to 78 and showing technical signs of an imminent breakout, we are at the modern equivalent of that $21 level, where consolidation is complete and acceleration is about to begin. And if you sell mining stocks Monday, you are exiting before the phase that produces the largest gains of the entire bull market, giving away leverage at the exact moment it's about to work in your favor. So ask yourself honestly, are you selling because you have real evidence that the bull market is over? Because you've seen technical breakdowns, major supply increases, or demand destruction? Or are you selling because you're afraid of volatility and giving back gains? Because your instincts are telling you to lock in profits, even though that voice has robbed investors of lifetime opportunities over and over again? Technical patterns mean nothing without fundamentals, so look at the supply-demand reality. Global silver production is about 830 million ounces per year and has been flat for a decade because 70% comes as a byproduct of copper, lead, and zinc mining, meaning you can't simply ramp up output without new base metal projects that take 8 to 12 years and billions in capital. Meanwhile, demand has surged past 1.2 billion ounces annually, creating a structural deficit of roughly 200 million ounces that must be filled from above-ground inventories that were built over decades and are now being drained rapidly. COMEX stocks are down 23% since mid-2024. Shanghai inventories have fallen 47% in 14 months, and London inventories are at their lowest since 2016. And when these stockpiles are depleted, prices must rise sharply to destroy demand or justify new supply. But silver demand is largely inelastic because solar, electronics, and industrial users can't substitute quickly, which creates shortage pricing, aggressive bidding, and sudden price gaps. We're already seeing early warning signs, with physical premiums at $18 to $23, the U.S. Mint suspending Silver Eagle production in 2025 due to shortages, and major dealers reporting multi-week delivery delays, all of which confirm these are no longer normal market conditions. These are the signs of a market shifting from normal conditions into outright shortage, and once that psychology takes hold, prices rarely return to old levels because the market reprices to a higher range that reflects constrained supply. If you're thinking about selling Monday to buy back at 60 or 50, consider this. Those prices may never appear again because industrial buyers are already willing to bid aggressively at 70 and above to secure supply they can't afford to lose. We've seen this pattern before during the uranium bull market from 2005 to 2007, when prices rose from $20 to $30 and early investors sold. convinced the move was over, only to watch uranium climb to 40, 50, and 60, with more people selling at every step, believing they were locking in smart profits until it finally peaked at $137 in June 2007, leaving those early sellers having missed the majority of the move. History remembers the asset, not the profits people thought they secured. The same psychology repeats in every shortage-driven rally, from lithium to rare earths, and now in silver, where the setup, emotions, and risk of regret are identical unless investors learn from the past. At the same time, the monetary backdrop makes this moment even more dangerous to misread, with the U.S. running multi-trillion-dollar deficits, debt growing at an unsustainable pace, and interest payments consuming more of the federal budget each year, leaving currency debasement as the only politically viable option, as central banks print to support debt markets and erode purchasing power by design. In this environment, holding cash means accepting guaranteed loss, while holding scarce, tangible assets means preserving value. So selling silver to sit in fiat currency is trading something limited for something endlessly created. This is happening as governments openly discuss critical mineral security. And when finance ministers and defense officials start treating silver as a strategic resource, it signals real supply stress. Because government buyers don't negotiate on price. They buy to secure availability. You've already held through weeks of consolidation and uncertainty, and now, just as acceleration approaches, many are tempted to exit, which is exactly how commodity cycles transfer wealth from impatient hands to disciplined ones. 5 genuine sell signals exist: collapsing industrial demand, major new supply, falling physical premiums, rising inventories, or a decisive technical breakdown, and none are present, not one. So if you sell Monday, understand why. It won't be evidence, it will be fear. And fear has destroyed more wealth than any market crash in history.